All right. Good morning, everybody. Zoom's acting a little weird, so that took me a moment. It's always doing something new. All right, so the market's got a lot to process. It's a jobs day today. It's not the big job numbers, but it's big enough. Anything connected to jobs, you want to pay particular attention to it. There's contagion coming out of Germany in the bonds market. They're actually voting to change their constitution to enact this bond change. It's a really big deal. We don't know how big it's going to get. It's rippling out around the world. And it's funny when you look back throughout history at how many times we've had economic crisis that's hit global markets. And it's almost always something you didn't see coming, right? Like when it's something the market can see coming, then they start to hedge against it. They start looking for solutions to it. They react with surprise and usually freak out and overestimate how bad things are going to be. And things just get really bad really fast. We don't know how big this situation is going to get with Germany, but it showed up out of the blue and it's starting to ripple out. So just keep your eye on the headlines, keep your eye on anything that's talking about Germany and its bonds and its change in the Constitution and how they're looking to fund defense. And see where it goes. We've got Fed speakers this afternoon. I doubt they're going to say anything new, but we always have to be concerned that a reporter is going to take them out of context, misquote them, that they can say something that they didn't mean to say it in a way that gets, taken out of context. So always be mindful of when somebody is speaking, but not all of these speaking events that we see, they're not always what they seem. Sometimes it's a pre-recorded message. Sometimes they're just at some sort of like lunch at a college or something. Sometimes they're not taking questions. So, just because it says that there's a meeting or that there's a Fed speaker today doesn't necessarily mean it's going to be, impactful. Something to pay attention to today is also European Central Bank, Christine Lagarde. I believe they were quoting her earlier about widening their nuclear umbrella to cover Germany. Kind of ties back in with Germany changing its constitution to adopt defensive money to defend itself. We've got some auctions today. We also have something coming out of Japan, is foreign reserves. I doubt that is going to cause any ripples, but there's just a lot going on. Boy, that's a big number change. Previous was 49,000. Layoffs actual 172,000. Nothing to see here, folks. So we still have that push to the upside in the 10-year. It's back above 4.2 and holding. We can see it faded back and gave a nice little retest. If this was just, like a pullback before continuing lower, then when it pulled back into 4.25, it would have dropped right back down, broke 4.2, and it would have challenged the low, and it didn't do that. Instead, It pulled back to 4.2 and it held, and now it's working its way back up. The dollar, on the other hand, really close to breaking below 104. And we have this setup in the ES looking a bit like a bear flag. Whether or not it's going to be a continuation or not remains to be seen. 58.50 is the line in the sand if we're going to get a failed bear flag and begin working our way back up. That's the level we have to get above and stay above. 58.50. We're under all the levels now: put wall, volatility trigger, call wall, zero gamma, and you can see that the call wall has been brought down and zero gamma is now the highest level. We're getting into more and more conditions that are beginning to resemble 2022 and the bear market. I'm not saying we're in a bear market. IWM is about to be classified as being in bearish territory or being in a downturn deep enough to be considered bear market territory, right? It's just a distance qualification, how far from the highs we are. So a little bit lower in IWM, that'll actually trigger that qualification. For me, it's more of like what Spot Gamma has been laying out in the last few days of the options behavior and the sort of price action behavior that we've seen on these recoveries, these minor bounces, the rejections, and the continuations to the downside. We've got our line in the sand. We've talked about 5,700, and I gave it a little wiggle room because in a violent market, we can overshoot targets pretty easy. 5,700 is the line that I've been giving. That hasn't changed. If we get and stay below 5,700, then I think things can start to get really nasty. But it won't take much to flip this market back and start running in the other direction. We still have a looming government shutdown, and that's weighing on people as well. We're below the ADR half. If we get to one edge early enough in the day, we can get to the other edge by the end of the day. So here we broke it. If we get back above 5802 or this lower ADR half, then we'll run it to the upside, look for a breakout above yesterday, and target 5887. Notice that we can hit the lower edge and still be inside of yesterday's range. And now that we've held underneath that 5,800 level, even after trying to test it, it wouldn't surprise me if we just go ahead and go down and hit that 5760 level. When I say that we could go to the other edge by the end of the day, that wouldn't necessarily be bullish. We're talking about the same kind of breakout look of what it would be yesterday when we broke the Globex high and we went up just a little bit more. And then we've been holding last night in a really tight initial balance before we broke down. Very likely we broke down through the kill zone between 2 and 4 a.m. Imagine that, sure enough. So there's your kill zone move. We've been consolidating down here. If we run back up into that zone that we were building in the overnight, might have a hard time getting through there. But even if we do break out of yesterday's high, then we've still got that ADR as a target, and we're not expecting much beyond that. Today's floor pivot is just slightly higher than yesterday's, but the channel is a lot wider. implying that if we attempt a breakout, the breakout doesn't stick and we come back in again. Now, these channels don't make price breakout. So just because it's wider, it doesn't mean we can't break out. These channels are designed to give us some clues about what to expect from price if we do get a breakout. Yesterday, the sentiment that I gave was that we're range bound, and if you're going to look for any good trading, let it break out. Get outside of the previous day's range, and then you'll have something decent to trade. We're in the same boat today because now we're starting to develop an IX10. That's an inside day that lasts more than one day. And while Tuesday was pretty wide, Wednesday was narrower. If we get another day that's even more narrow, then it's not just an IX10, it's an IX10 that's compressing. Compressions in the markets lead to expansion. Our distance from the weekly pivot is still not extreme enough to expect any sort of mean reversion. So we would have to break down below 5750 and expand into 5700 to start to fill that pull for a reversal. At this point, we've spread out the distribution through the entire value area, so we're not getting a lot of assistance or insight from the weekly profile other than where is the point of control, 58.26. So this isn't really helpful. You know, when it comes to indicators, sometimes they have value and sometimes they don't. What I tend to focus on is if there's nothing there, then just admit there's nothing there. I know that might seem kind of obvious, but you'd be surprised how often I see people really digging into something that just doesn't have anything to offer because they think that there's got to be something. If there's nothing there, there's just nothing there. And this is trash. This is not helpful. Ten-day, 30-minute volume profile with TPO. The TPO and the volume profile have a matching point of control. And it's over our head. It's not expected to move anytime soon, but we are building out some volume at this level. Unfortunately, we're distributing it from 5,900 down to 5,750. So this wide distribution and just scattering it across the masses is not helpful. And it's not lining us up with any targets or price shelves or anything of value. A run to the upside is going to have to challenge that 59.64 point of control. And at this point, we're not looking to see it move because we need to either stay in one spot or start wiping out the candles that are there. And we won't get to those candles for another 5 days at least. It's a lot easier to see the compression or the IX10 once we get down into the 5x5 with this matching profile day after day. So we're building out the levels just like we were back here when we had multiple days staying between 58.50 and 60.20. Now we've just changed lanes and we're hanging out down at this level. This is a leg down. When you've heard me talking about a leg up or a leg down, we legged it down into this zone. We're now running in this zone and we're looking for a leg out. There's no direction implied in that. We're just looking for a leg out. We got a GTF out of this zone, right? So get out of the zone and we'll see which direction we go. If it's a downside break, we got 5,700. We got to resolve that. if we can just get down and test it and wash it and get it done, start our way back up, that'd be fine. Otherwise, just run it on up, break this high on, what is that, Tuesday's high, and begin working our way back up into last week's levels. No new point of control for today. We already took it out. Yesterday's point of control was under 5,800, pretty close to the 5792 cog line. We're back into that zone this morning. It's really where we're hanging out, but it didn't seem to have offered any value or any insight. Still outside the box. If we do get a run to the upside, and if we can get above that 58.50 level, then we can get back into the range that we were supposed to hold for the week. We're supposed to close inside that box 70% of the time if we're running on a normal standard deviation. The S&P has a really accurate expected move model, and it tends to close inside the box more than 70%. Normally, I say it's closer to 80. But in high volatility, we start missing and the numbers fall off drastically. We're still below the 10-week. We're at minus 3.25, just kind of rounded a little. If I stop my mouse there, you can see that this is pretty extreme. We've been lower than this within the last 24 months. Okay, a little more than that, right? Last 18 months. Back here in October 2023. But it took a lot of time to get that far down, right? We had a consistent, persistent move to the downside with nice, clean price action, lower highs, lower lows, really great structure, and it worked its way down there from like July to October. We've made this trip a lot faster. Still, the only thing that's below this level, other than that pullback in 2023 that we were looking at, is the 2022 bear market. It's not the distance that we are below 10 that's a concern. It's staying below 10 that will become a concern. You can see how long we were holding out below the 10 when we were in that bear market. We were living down there. So we want to see these sharp reversals and moves back in the other direction. We don't want to spend a considerable amount of time down here. We're 2% below the 10-day. Stopping my mouse at that level, you can see that's about as far as we go. When we overshoot, which is, it does happen, we don't tend to stay underneath that level for very long, and we come back in again. Quick little dips below the line and back up. Other than when we were in the bear market, we spent a considerable amount of time below that level. It's not to the point where I would say it owes us some sort of mean reversion, but it's hard to see us continuing to go to the downside from here without first digesting what we've already taken. The analogy that I use for this a lot of times to kind of help newer traders grasp the logic is, imagine a runner trying to run up a really steep hill. And after every 25 steps, you stop them and put more weight on their back. And then you let them run some more and stop them, and you put more weight on their back. You're not telling them they can't run up the hill. You're not tripping them or blocking their path. You're just putting more and more weight on them the higher they go. And of course, the higher they go, you got elevation issues, the steepness. It's just more and more difficult to continue to move in the same direction that they're going. That's price at this point. Can we go lower? Oh yeah, absolutely we can go lower. Price can do whatever it wants. But at this point, at these extremes, to continue to go lower would be more and more and more effort. Chips are down, technology, Mag 7, gold miners, solar, consumer discretionary, expanded technology, growth, biotech, uranium, financials. It would almost be easier just to flip it over and say, well, what's up? The VIX. Imagine that. Hey, the VIX is up. The China group, China again. And yeah, we are in backwardation. If you look at the VIX using ETFs like VIX 1 day, VIX 9 day, VIX, if you look at the VIX futures, which on Thinkorswim, they make it kind of easy to see backwardation because you can see all of the contracts. So we can look farther out in time, March, April, May, June, July, blah, blah, blah. And we can see the price next to them. When it comes to backwardation, I know it's fancy language, contango, backwardation. Contango means normalcy, that as we go farther out in time, things are more expensive. This makes sense. We see it in the options market. We see it in pricing models because we just don't know what's going to happen out in the future. War, uh, crop failure from bad weather, hurricanes, all sorts of things can happen in the future that we just can't price in and we don't know. So prices are more expensive. This behavior is contango, that prices farther out are more expensive. When we get into backwardation, which is a really fun, fancy word, it just means the opposite. Things in the front end are very expensive and things farther out in time are cheaper. This is a sign that investors or big money is more concerned about things right now in their face than they are about things that are farther down the road that they don't know could hit them. So when we look at the VIX futures, or even if we just use the VIX ETFs, we can look at the ones that are in front and then look at the ones farther away and see which ones are more expensive. The one that's going to expire in 12 days, it's the active volatility futures, is at 21.5. Just round up a little so it's easy numbers. If we look at the next contract out at 41 days, it's at $20.87. So the one in the front end is way more expensive than the next one out. And the volume's not that bad between the two, right? It's not like 600 contracts versus 10,000 contracts. It's 10,000 versus 6,000. Now, don't get me wrong, that's not crazy liquid, but it just shows that it's not because it isn't being traded. They're both being traded. The front end is just getting bid up more. If you don't have the VIX futures, you can just use the VIX and put a number behind it. So you got VIX 1. That's your 1 day. It's at $22. You got your VIX without a number behind it, and this is a 30-day VIX. It's at 23.5. So we actually came back out of contango. We were in it yesterday. We came out of backwardation. We're back in contango. Keep your eye on this. See if that front end gets bid up again. It'll be a nice warning because we were in it. We came out of it. Watch to see if we go back in it again. You can put these in a watch list so that it's easier for you if you're not used to doing this. I'm going to do it on Thinkorswim, but you can do it on whatever, TradingView, whatever you're using. There's a 9 day, Then there's just the VIX itself, which is 30. Then there's a VIX 6-month. And there's a VIX 1 year. Once you put all those into a watch list, you can see their price and see if one is more expensive than the other and in what order, so that if we do slip back into backwardation, you'll be able to spot it. We're back into contango at this point, so just keep your eye on it. Getting a little rebound in crude. It started to come back up yesterday. It just looks like it's trying to continue that move. You can mark all of yesterday on crude, see if it can get through the halfback. Because if this is going to reject and continue to the downside, then a halfback rejection would be a nice setup to continue that short. But it's already taken a huge leap to the downside. It wouldn't surprise me if we digest down here, or if we try running back the midpoint of this entire run, which would be somewhere around 74-ish. So if we get through the midpoint of yesterday, we target yesterday's high and then target 74. Short-term move to the upside, more of a reflexive bounce than any sort of run back, right? Maybe a bit of a mean reversion. So volatility, China, crude, building materials. We're getting some agriculture up this morning, a bit, not much. That big move we saw in junk already got taken out. It was like just a little algo print, little weirdness down there, and then we were back up where we were. So that dark pool print, it's worth keeping an eye on it, but we've seen these before. If you kind of zoom out, there was another one here where we had a big move. So maybe it was just one of those, right? Where we just get some weird behavior like this, and it doesn't amount to anything. But yesterday, it sure started out looking pretty bad. We don't have any of the sectors that we would want to see today for a rally. So that makes it easy. Once we're in the intraday today, look for the sectors that we need for a rally. That's one thing. They're easy to spot. And then watch the options flows in the S&P and the Qs, because if we're going to rally, it's going to be from one of those two groups. Either the options are going to come in and move us, or the Mag 7 is going to move us. Without that, it's very likely we stay inside the range like we did yesterday, waiting for more data like POW on Friday and more jobs data and unemployment. We got to get out of this range. So that's what I got for you guys. Be careful, be safe. I'll see y'all tomorrow.